Last week in global markets, wow, it felt like watching a high-stakes tug-of-war. On one side, pure optimism pulling stocks higher. On the other, fear digging in its heels, trying to drag everything back down. So what was really driving this battle between hope and panic? Big bank earnings were booming, the Fed was hinting at future rate cuts, and trade tensions were cooling off. But under the surface, credit markets started to tremble. Europe's growth stumbled, and China flashed a deflation warning sign. This week, everything could tip one way or the other, with key data from China, the UK, and the US all landing at once. The market's betting on a Fed rescue. But will that faith hold? Want to understand what's really moving global markets? Watch the full episode of this week's MacroNav, and don't forget to like, share, and subscribe so you never miss the story behind the numbers.
So last week in the global markets, wow. It really felt like watching a high-stakes tug-of-war. You had this huge surge of optimism on one side, pulling stocks up, and then on the other, this growing sense of fear trying to drag everything back down. So what in the world was driving this conflict? Let's get into it.
And you could see this split personality pretty much everywhere. On the one hand, you had reasons to be cheerful, right? We saw surprisingly strong earnings from the big banks, some major hints of future rate cuts from the US Federal Reserve, and trade tensions seemed to be cooling off. But then, on the other hand, you had some serious storm clouds gathering, real jitters in the credit market, economies slowing down overseas, and that constant low drumbeat of geopolitical risk.
Okay, so let's start with the good stuff. What was getting investors so excited? Well, it really boils down to one single, incredibly powerful force, the US Central Bank. Now, this is a really big deal. For what feels like forever, the market has been laser-focused on one thing, fighting inflation. But now, Fed officials are starting to signal a major pivot. They're hinting that they might start cutting interest rates, not just to manage inflation, but to actively protect the economy, even if prices are still a little higher than they'd like.
And here it is, the exact phrase that made everyone sit up and listen, straight from the Fed chair himself. Look, when the head of the Fed starts talking about downside risks to employment, that is a massive signal. It tells the market that their main worry is shifting from just inflation to making sure the job market doesn't weaken. For investors, that's the green light they've been waiting for.
And this optimism wasn't just some vague feeling, you know? The data was actually there to back it up. Get this, an incredible 86% of S&P 500 companies that have reported their earnings so far have actually beaten expectations. And this was led by some of the biggest banks out there like JP Morgan and Citi, which showed that the core of the financial system is holding up surprisingly well.
So what did all this good news add up to? A pretty solid rally. You can see it right here. The major US indices all posted some really healthy gains, winning back what they'd lost the week before. The market was basically voting with its wallet, buying into this whole optimistic story.
But just as the party was getting started, some warning lights started flashing, because underneath that shiny surface of the rally, some pretty serious cracks were starting to show, and not just in the US, but all around the world.
Right here at home in the US, the credit market started to get super nervous. There were some troubling reports about fraud at some regional banks, and a spike in bankruptcies in the subprime auto sector. We're talking about companies that give car loans to folks with riskier credit. This nervousness caused the VIX, which is kind of the market's fear gauge, to jump to its highest level in months. And what happens when fear goes up? Investors started running for the safety of gold and government bonds.
Now let's hop across the Atlantic. Europe is really a tale of two different economies right now. On one side, you have France having a fantastic week. Its market was up over 3%. But then you look at Germany, Europe's industrial engine, and it just slumped badly, with its main index falling over 1.5%. That weakness in German manufacturing is a huge drag on the whole continent.
And the story's not much better over in the UK. The economy there is basically just treading water. I mean, a tiny 0.1% growth rate, that's pretty much a standstill, and their once hot labor market is definitely starting to cool down. The UK economy is looking very vulnerable right now.
Meanwhile, over in China, they've got the complete opposite problem from the West. It's not inflation, it's deflation, where prices are actually falling. Now you might think, hey, falling prices, that sounds great. But for an economy, it can be really dangerous. It makes people put off spending, and that can kick off a downward spiral. And that doesn't just hurt China, it hurts everyone, because it reduces global demand for stuff. The fact that their consumer prices actually fell year over year is a huge red flag for the entire world economy.
So, what a setup, right? You've got a market that desperately wants to rally, but it's surrounded by all these global risks. And that brings us to the week ahead, which is just jam-packed with events that could finally resolve this tension and tip the scales one way or the other.
Okay, so this coming week is basically a minefield of market-moving data. It all kicks off on Monday with a massive economic report out of China. Then, on Wednesday, all eyes will be on the UK's inflation numbers. After that, the focus shifts back to the US with two huge reports: weekly jobless claims, a key number the Fed watches, and then the main event on Friday, the Consumer Price Index, which is going to give us the clearest picture of where inflation is really heading.
And look, each one of these events carries a major risk. If that US inflation number comes in hotter than expected, you can probably kiss that rate cut dream goodbye. If we get weak policy news out of China, investors might just run for the hills. And any more persistent problems in the UK, Germany, or even Japan could easily add to the global gloom and just overpower all that optimism from the Fed.
So after all of that, what's the one crucial thing you really need to take away from all this? It's that the current market rally, it's really built on a single, very high-stakes bet.
At its very core, the market is choosing to believe that the Fed is going to ride to the rescue with rate cuts. Investors are taking a massive leap of faith, betting that the Fed's support is going to be enough to overcome all those cracks we just talked about, the credit risks, the slowdown in Europe, and that deflation problem in China.
Which brings us right back to the main question. This week's data has the power to either validate that faith or completely shatter it. The battle, that tug-of-war between hope and fear, is coming to a head, leaving us all with just one question. Is this leap of faith really worth taking?
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.